Okay, let's explore this double declining balance depreciation problem. Now, the problem you can see in front of you, it says, let's say we purchase equipment on January 1st, 2010 for $100,000 that has a salvage value of $15,000 in a 10-year life. What would be the first and last year's depreciation using the double declining balance method? And by depreciation, we mean depreciation expense, the dollar amount that will appear on the income statement. Now, before we tackle that, let's first assume the assumption was a salvage value of $10,000. Okay? And using Excel, you see I've entered the cost here, $100,000. And then I calculate the first year's depreciation by taking 1/10, that's the straight line method, times 2. You can see it in the formula here, or you can look up here. And we multiply that times the book value. So the first year's depreciation is $20,000. And by the way, the depreciation rate is 1 divided by 10 times 2, or 20%. We have a book value of $80,000. And then we simply can copy those formulas down, and we can calculate the depreciation for every year, including the last year. And at the end, we see that the book value would be $10,737 when we're done depreciating this using the double declining balance. Since $10,737 is more than the $10,000 assumption of salvage value, this approach is a fine one to use. And we don't have an adjustment for the year 10 depreciation. All right, but now let's see what happens when the assumption is that salvage value is $15,000. Okay, so again here, we put in $100,000 as our purchase price, and we're going to use the same formula, 110 times 2, to get us a 20% depreciation rate. When I say 110, I mean 1 divided by 10. So it's a 10% straight line method. We double it to come up with double declining balance. And we have the same depreciation per year. And in fact, we will have the same depreciation per year in all years, except that we're not allowed to depreciate below salvage value. So we see in year 9, the book value looks like it's $13,422. We can't do that. Okay, so the most we can depreciate this down is to $15,000. So if the book value was $16,777, the most we can depreciate in this period would be the amount that gets us to $15,000. So if I take $16,777 minus $15,000, that gets me to my book value, and there would be no depreciation in the last year. Okay? So that's what the last year's depreciation would be with the $15,000 salvage value. The last year's depreciation would actually take place in the 9th period, and there'd be no depreciation in the last period using the double declining balance method.